Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a topic that I think many equity investors are interested in, which is how do you repair a losing stock trade using options? And I particularly like when we are covering this particular topic because the reality of repairing a trade is that it's not that easy. It's not particularly applicable to all environments. You can't use it for every single stock that you have a losing position on. It's really only useful for a handful of scenarios, but I do happen to think that the market environment that we currently are in is an environment that many of us may find ourselves currently in and is actually suitable for putting on a repair trade. So I think today is a very timely topic for this to talk about. And I do want to talk about the challenges with trying to repair a losing stock position using options so that you really understand when it can be used, when it should not be used, and what challenges that you'll come across as you try to deploy one of these strategies for your portfolio. So let's go ahead and get started. Now, before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And I'm going to try to keep today's session to be fairly interactive, where I'm going to allow the audience to submit symbols on stock positions that you've lost money on, and we'll try to find a repair strategy for your position. So before we do that, we have a pretty packed schedule for October coming up. There are some special things that we're going to be doing. I'll be doing an election special next week. I'll be announcing some of that tomorrow morning during our Friday morning market outlook session. So I hope that some of you will be joining us. But today we're talking about repairing a losing stock trade using options. Next week, we're going to talk about credit spreads. We are going to reintroduce our credit spread report, give you a better understanding as to how to use it, especially in the context of best practices for selling credit spreads. We'll use the credit spread report to find some examples to go through and trade, look at some real examples to show you best practices for trading those strategies. And then the mid-October is going to be earnings season. So I can't believe we're going to launch another earnings seasons again. So we're going to talk about best practices for earnings season, talk about what we expect this particular earnings season. I think this is a very important one. Not that the previous one was not important, but this one is specifically going into the election. So we want to talk about what our expectations are. And then lastly, on the last Thursday, we'll be doing a live market analysis. We are going to be taking the last Thursday off this month. So these are the 4 educational events for the month of October. I look forward to having you guys join me for that. But like I said, next Friday, we're going to be doing an election special during our Friday morning market outlook session. So a little bit more on that tomorrow morning. So I hope that you guys are able to join us tomorrow morning at 9 a.m., which is where we do our weekly market review. We are at a very pivotal moment in the equity markets. We're back at some of those resistance levels that we talked about on Tuesday. Are we going to break back above and have markets resume this bullish trend, or is this going to be a temporary top and markets are going to start reversing lower? We're going to explore all of those things tomorrow morning and take a look at the levels that we're paying attention to for that. So I hope that you're able to join me tomorrow morning. So let's first talk about stock trade has gone wrong. The question is, what are your options? What can you do after a trade has gone against you? This is a stock position. This is where you buy a stock and the stock declines. And then we're going to talk about what is a stock repair strategy? How do you actually construct it and understand a little bit about the stock repair strategy calculations and what are the potential outcomes once you put on a stock repair strategy. And then I want to talk you through some of the tips because there are some challenges with this type of strategy. They're not useful in all scenarios. So I want to make sure everyone understands when you should use it and when should you not use it. And then, like I said, we're going to try to go through as many examples as possible. So the primary question that I want investors to be able to walk away from today's session is to understand, how can I repair a stock position that has declined in value using options? That's what we're here to explore. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. I've used this strategy only a handful of times in my own portfolio because, like I said, it's only useful in very specific scenarios. And even if you're able to successfully find a repair strategy for the stock position that you're in, they don't always work out the exact way that you're hoping that they would work out. So today, what I want to do is I want to make sure everyone understands, number one, how to construct it, but more importantly, what are the challenges that you may face after you put on a repair strategy. So a stock trade has gone wrong. You buy a stock, let's say you buy the stock at $100, you think the stock is going to go higher, but instead of going higher, it declines in value. And the question is, what do you do once the stock has declined in value? Number one, I think a lot of investors do this. They hold and wait. A lot of investors, for one reason or another, choose to not take a loss. They just hold on to it, even if they hold on to it for months, sometimes years, for a stock to get back to break even. That certainly is one method to do so. And if any of you like this hold and wait method, please type 1 into the chat window. If you don't like to take a loss on a stock position, you'd rather just hold on to it and wait for it to come back. Okay, I see some ones, not a whole lot. I'll be honest, this is not my favorite strategy. The other one is dollar cost average. Some people like to say, well, you know, I like the stock at $100. Now that it's not down at 90, why don't I buy some more? Because then if it jumps up to, let's say, 95, I'll be able to break even without the stock having to return to 100. How many people like to dollar cost average? Please type 2 into the chat window if you like to dollar cost average. Now, this is a slightly more dangerous game because now you're adding on more risk, right? Now you've potentially doubled the risk, and now you still have the stock can go lower, and you can lose more and more money, and you can potentially do this over and over again. And some people have successfully done it, but I've also seen some pretty spectacular declines. Some energy stocks fall in this particular category, some financial stocks that have effectively gone bankrupt. You know, people have lost a significant amount of capital dollar cost averaging, so be careful on that strategy. Next, sell your holdings. So after the stock declines from $100 down to 90, you say that I like the stock at 100. The fact that it's declined to 90 tells me that I was wrong. I'm going to get out of this trade and simply move on to the next trade. This is, from my perspective, from a risk perspective, the better one to do, because at the end of the day, if you find a better place to deploy your capital, you're better off doing it than holding on to your trade or hoping that the stock comes back. So if any of you sell your holdings, please type 3 into the chat window. Now, obviously, each specific scenario is a little different, right? Some stocks you're holding on to for the long term anyway. Some stocks you're trading. Everyone's a little different. So I'm not suggesting that one is necessarily better than the other all the time. Each one is a little different. And lastly, we have the stock repair strategy. And the stock repair strategy, for all intents and purposes, is somewhat similar to dollar cost averaging. But the difference between the stock repair strategy and dollar cost averaging is that you're trying to improve your break-even price. But what it does is that it caps the potential rewards at some point, but it adds no or little additional risk. So when you dollar cost average, you have the same idea, but dollar cost averaging adds risk to the trade. Dollar cost averaging doesn't limit your upside returns, but it does add a significant amount of risk. And that's why I don't particularly love dollar cost averaging. The stock repair strategy improves your break even the same way a dollar cost average does, but it doesn't add any additional risk. And the only downside to it is that it caps your potential rewards to the upside. So if you buy the stock at 100, declines to 90, you put on a repair strategy and the stock goes back up to 110, well, guess what? When you dollar cost average, you'll participate in that movement. When you use a repair strategy, you will at some point no longer participate in any further upside beyond a certain amount. So those are the challenges, if you will, when it comes to dollar cost averaging versus repair strategy. So what is a repair strategy? First of all, I think it's important to understand, because many times when we're in a losing trade, you know, we have two needs, if you will, usually when we have a losing stock trade. Number one, we want to stem the downside risk. We don't want to lose any more money. And number two, we want to get ourselves back to break even quicker or quicker than we would normally if we just simply held on to this trade. So the first thing I want to make sure everyone understands about a repair strategy using options is that it does not provide any further downside protection. So if a stock is trading at 100, it declines to 90, and you put on a repair trade, and instead of the stock going higher, the stock continues to move lower, the repair trade does not stop you from losing any more money. You will continue to lose money if the stock keeps going lower. So that's still the risk that you take after you put on a repair trade. Now, what it does do is that it requires you to believe that the stock is going to rally after you put on the repair trade, meaning you should not put on a repair trade unless you believe that now the stock is going to rally. But not only do you believe that the stock is going to rally, you have to believe that the rally is going to be fairly slow. And this is something we're going to explore a little later as we go through go through some real examples. But if you think the stock's going to make a very quick bounce back to, let's say, your break-even point, guess what? A repair strategy is not quite suitable for that, and I'll show you why. And lastly, the most important part, and this is probably the most restrictive part, is the fact that a repair strategy typically will only work if the trade or the stock trade that you're in has lost somewhere in the 5 to 7% range. Anything less than that, it's not worth repairing a strategy, putting on a repair strategy. But if you're down 25%, there's no repair strategy that's going to magically fix your stock position. It only works in this kind of magic realm of this 5 to 7%. And I know that's not a particularly large realm, but that is where the current market is from their all-time highs. It's about 5 to 7%, depending on what stocks that you own, which is why I think this is a particularly interesting time, especially if you believe that stocks are going to start rallying again, especially if it's going to rally at a slightly slower pace, given that we're heading into election. There's a lot of fundamental and economic devastation in this market. So you think that the rally is going to be fairly slow. This is, in my opinion, potentially a market for a repair strategy. Now, if you do put on a repair strategy and the stock does rally higher, what it does is it improves your stock break-even price. So if you buy a stock at 100, your break-even price is at 100. Now, if the stock declines to 90 and you put on a repair strategy, what you might be able to do is change that break-even price down to 95. So as long as the stock recovers back to 95, you'll be able to break even, and you'll be able to profit if the stock does get all the way back to 100. So at 95, you'll break even. If it gets back up to 100, you'll actually be able to turn a profit. So this is the benefit of a repair strategy. It does cap the unlimited upside of the stock. So if instead of going back to 100, it goes back up to 110 or 120 or 130, you're no longer going to participate in that. That's what you're effectively giving up by reducing your break-even price down to, let's say, a $95 break-even price. You're giving up that unlimited upside in exchange for a better break-even price. But keep in mind, your downside risk still remains. So when you put on a repair trade, if the stock keeps moving lower, your downside risk will still be there. It's not like the repair strategy does not prevent you from losing more money if the stock continues to decline. Does that make sense, everyone? Please type 4 into the chat window if this makes sense to you. Okay, so like I said, it's a strategy that can improve your break-even price in exchange for limiting some upside, but it doesn't provide your downside protection. But from my perspective, the most limiting part about the strategy is the fact that it only works if you've lost less than 5 to 7%. If you've lost 10, 15, 20%, 50%, there's no repair strategy that's going to work in your favor. So what we're going to do is we're going to do a very quick example. You bought 100 shares of a stock at 100. At the time that you bought it, you thought the stock was going to continue moving higher, but a month later, the stock has now dropped to $90. Now that it's dropped to $90, you now believe that it's going to rally back up into the $95, $98 range. So let's take a look at potentially putting on a repair trade. So as I said, I think we're going to find a lot of stocks that kind of fit into this general category based on the recent declines we've seen in the market. So I own 100 shares of XYZ at $100. How do you put on a repair trade? This is where it gets, especially for someone who's relatively new to options, this may sound very confusing, but I'll try to break it up in different ways to make it a little easier to understand. But what you're effectively doing when you put on a repair strategy is you're selling a call ratio spread. You're selling a 1/2 ratio spread. And I know ratio spreads are a little confusing. So the better way to think about this is, instead of thinking about it as a ratio spread, think of it as either what you're doing is you're buying one call option, and in exchange for that, you're at the same time selling two call options. And the best way to understand this is, what you're doing is you own 100 shares of XYZ at $100, which means that because you own 100 shares of that stock, and that was one other thing I forgot to do on the last slide, is that you must own 100 shares of this stock, because in order to use the repair strategy, you need to be able to sell a call option against your position. So if you own only 20 shares of a stock, you cannot do a repair strategy on this. So like I said, it's a limiting strategy. Not everyone has 100 shares of the stock that they are down 5 to 7% on, and you may not be down 5 to 7%. You might be down 20%. So this is, again, a limiting strategy. But if you own 100 shares of a stock, you're down about 5 to 7%, you think the stock is now going to rally a little bit further, this is where you can use a ratio spread. And what you're doing when you're putting on a ratio spread is you're selling a cover call against your original 100 shares. And then what you're doing is you're taking the proceeds of that cover call, and what you're doing is you're buying a call debit spread. And the goal is so that the cover call that you sell pays for the cost of the debit spread. And you want to trade this either at a very small debit, so sometimes you have to pay a little bit, sometimes you get paid a credit to enter this trade. But generally speaking, you want to be able to place this trade for virtually zero cost, meaning it's not going to add any risk to your portfolio, and it's not really reducing any risk to your portfolio. That's generally speaking the ideal ratio spread. So that is how you put on a ratio spread. So in this example, I own 100 shares of XYZ, $100. It has now declined down to $90. So what do? I sell a cover call at $100. I sell it at my original break-even price. I want to sell a $100 call option. And then what I'm going to do is, let's say I sell a $100 call option for $1.50. I sell one cover call for $1.50. And then what I try to do is I try to buy a debit spread with that $1.50. So what I do is I buy a call at the current price of the stock. So if the stock declined to $90, I'll buy a $90 call option, but let's say that costs $3. What I'm going to do is I'm going to sell a 100 call option against that, again, to turn this into a debit spread, collecting $1.50, which is the same strike that I originally sold that cover call on. And now I have what's considered a repair strategy. Now, because I paid $3 for the $90 call option, I sold a $100 call option against the $90 call option that collected $1.50, and then I sell a cover call against my stock position, collect another $1.50. That's how I'm able to trade this ratio spread for a net debit of 0. So I don't have to pay anything, because the cover call will offset the cost of the debit spread. And what you're trying to effectively do is buy a free debit spread on this trade. And a debit spread means that there's the risk on the debit spread is what you pay for it. So if you paid $0 for it, you're not adding any risk. But when you have a stock position and now a debit spread, what happens is that if the stock does rally, you'll make money not only on the stock, but you'll also make money on the debit spread. So if you just traded the stock, you would still be down. But if you traded the stock and the debit spread, what you get yourself back to is break even a little faster. Now, if the stock continues to go beyond your new break even price, what you can do is actually make a profit if the stock goes back to your original break even price, because you're long the stock and you're long the debit spread. Now, the only downside to this strategy is that if the stock exceeds your original break-even price, if you had just held on to the stock position, you would make more and more money. If you put on the repair strategy, what happens is you will not make any more money beyond your original cost basis. So what you're effectively giving up is this upside all the way up here for, in exchange, this better break-even price here. So what options is really doing is it's a very creative way to shift around where you make money and where you lose money. What we're doing here is we're giving away some upside in exchange for making our money back a little quicker. Does that make sense, everyone? Please type 5 into the chat window if this makes sense to you. And if this does not make sense to you, that's okay also. I think that when we go to the real examples, that will make a little bit more sense to you, because once we go through some actual stocks with some actual strike prices and expiration dates, this will make a little bit more sense to you. But that is at the core of the strategy. What you're trying to do is you're trying to find a way to buy a debit spread for free by selling a cover call against the stock that you own. Now, you're going to find very quickly when you try to do this, most of the time, you're not going to be able to find this unless the stock is in that magic 5 to 7% decline. So this is a theoretical example here that I'm giving you where the stock's down 10%, but in reality, you'll tend to find that even at 10%, it's becoming increasingly difficult to find these types of strategies unless you're in a relatively high volatility environment, which we happen to be in. So this is, again, a better environment to potentially put on a repair strategy. Now, when you put on a repair strategy, how do you know what your new break-even price? This is where it requires a little bit of work, but it's not that difficult. What you do is you calculate the break-even price of the cover call that you sell, and you calculate the break-even price of your call vertical, the debit spread that you were able to effectively finance with your cover call. And then what you do is you average the break-even price between the two. So when I buy a $100 stock and I sell a cover call on it at $1.50, my break-even price is $98.50. When I buy a call vertical that has a lower strike of 90 that I pay $1.54, that means my break-even price on that is $91.50. So the difference between these two numbers, that's your new break-even price. So in this particular case, I used fairly easy round numbers so that everyone can understand, but my new break-even price is 95, which is simply just an average between these two numbers. You don't have to necessarily remember this, but it's just there so that you can understand how your new break-even price is calculated. So let's take a look at the scenario, right? So now we've learned what a repair strategy is. Let's take a look at how this performs. So same example, I own 100 shares of XYZ at $100. The stock declines to 90 and I put on a repair strategy at that $90 level. So this is my starting point, if you will. This is my starting point. This is where I put on my repair strategy. Now, if let's say at the expiration date, the stock doesn't rally, but it also doesn't decline. It stays at 90. The two, whether I put on the repair strategy or not, the two strategies are identical, which means that I'm not risking any more money, but I'm also not making any more money if the stock doesn't move. Now, the first thing I want to, again, reiterate is that if the stock does move lower, so I put on the repair trade, and instead of rallying higher, the stock actually declines in value. Again, when that happens, the repair strategy does not prevent you from losing any more money. So in the two examples, whether or not I put on the repair strategy or not, if the stock continues to decline, I still continue to lose money the same way if I didn't put on the repair strategy. Now, if the stock does rally back up to 95, this is where originally in my stock trade, I would have lost $5 because I'm still not back to my original break-even price. I've still lost $5 a share, but on my repair trade, I would have gotten myself back to break-even. So this is really where the repair trade starts to shine, is when you put on a repair trade and the stock starts to rally. You will make your money back faster than if you did not put on that repair strategy. If the stock gets back to original break-even price, if you had just held onto the stock position, you would break even. if you put on the repair trade, you would actually make a profit. So if you got back to your original stock break-even price and you put on a repair strategy, you would make a profit. If you exceeded your original break-even price to the upside, up to a certain amount, you will actually be the same between the two. So at some point, the original stock trade starts to now outperform the stock repair trade. If the stock makes a big move to the upside, your original stock trade would benefit from that, but your stock repair trade would be capped at the $10 maximum that you can make. You cannot make any more money if the stock rallies significantly. So that is what it generally looks like. So what you find is that it's only a narrow band at which the repair strategy will outperform. If the stock continues to move lower or stays where it is, you're basically the same. If the stock makes a big move to the upside, you start to underperform. Only in this specific range do you make more money with the repair strategy than if you did without the repair strategy. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. Okay. I know I saw a few questions. I will come back to your questions here at the end. So let's just talk a little bit about what we talked about and some of the nuances that I still haven't gotten to that we'll get to when we talk about the real examples. Number one, this strategy requires patience and requires you to hold the repair strategy close to the expiration date of the repair strategy. So if you put on a repair strategy, so let's say you have a $100 stock, the decline's at $90, you put on that repair strategy, and the stock quickly gets back up to 95, your new break-even price. But let's say it happens in a week, but the repair strategy you put on was 45 days. You put on a 45-day option, and the stock returns to your break-even price at 95. Guess what? You don't actually get to break even at 95. You get to break even at 95 at expiration. So what you have to do is you actually have to hold on to this trade, wait till the expiration date or close to the expiration date. And at that point, do you realize your profits? This is a major challenge to the repair strategy because not only do you have to get the direction correct, you also have to get roughly the timing correct. Because if the stock makes a big move to the upside or rallies very quickly, you're going to have to wait. You're going to need the patience to wait for this to decay in value because most of that comes from the time decay as you get closer and closer to expiration. So when you get a sharp rally with the repair strategy, it may actually lead to a paper loss. So you might actually see an unrealized loss on your repair strategy, and you have to wait till expiration to wait for that unrealized loss to turn back to an unrealized gain. Now, the other thing is that you have to consider is that these are multi-leg trades that adds transaction costs, that adds commissions. So if you're trading in a very liquid stock, the transaction cost should be fairly negligible. But if you're doing it on a small cap stock, something that doesn't trade a lot of options and the bid-ask spreads are really wide, you have to factor that into your transaction costs and whether that makes sense for you to put on this repair strategy. It does require at least 100 shares because in order to sell that covered call, for you to put on the repair strategy, you must have 100 shares. It generally works better in higher implied volatility environments like we are in right now, but more importantly, it only works when you have trades, it doesn't work for trades that have greater than 5 to 7% losses in your portfolio. And I know there are plenty of stocks that you might be down 10, 20%, can't put on a repair strategy for those trades. And you must be bullish. You can't just put on a repair strategy because you've lost money. You should only put on a repair strategy after you think that the stock is going to start to rally now. Because like I said, if the stock keeps declining, if it just stays where it is, the repair strategy is not going to do you any good. And all you're going to do is pay transaction costs for something that's not going to provide you with any benefits. And again, lastly, it doesn't provide any downside protection. So like I said, it's a powerful strategy, but it's a very limiting strategy. It's important that you know what those limitations are before you place it, because like I said, it's not suitable for all environments, suitable for very specific environments. So with that, let's go to OptionsPlay and let's look at an example. So if at this point, if you have a stock that you own, please type in the symbol and the cost basis that you own the stock at. and we'll take a look at it together to see if we can potentially find a repair strategy on your stock. So the stock symbol and the cost basis of your stock. So I'm going to use Facebook as a quick example to give you guys just a quick sense, okay? We're going to look at Facebook, and let's just assume that you bought Facebook at 290, which is all the way up here, right? Let's say you bought it at 290, and now the stock has declined down to, 250, 260, and you're saying to yourself, okay, it's touched that support level, it's bounced off of it. I think it's going to continue getting back. I don't know it's going to get back to 290, but maybe it'll get back to 275, maybe 280 at a stretch. So you're thinking to yourself, okay, maybe I can get myself back to break even. So let's take a look at putting on a Facebook repair strategy. So first of all, what I'm going to do is I'm going to do a long call ratio. And what you're going to have to do is you're going to have to buy a call option at the current price of the stock. So it's trading at 267. Let's say I buy a 267.5. And what I'm going to have to do is I'm going to sell 2 calls at my original cost basis, which is around 290 or so. So let's say I sell 2 calls at 290. So notice how this trade cost here. So I sold one 290 call for two of the 290 calls for $8.35, and I paid $17.75 for one of the 267.5 calls, so the at the money call option. And what that does is I've effectively created a debit vertical spread, a 267.5, a 290 vertical spread, and I've sold an additional cover call from my stock position that I own. And notice how the trade cost here is just $10. So it's a 1 cent debit effectively on my trade. Sorry, a 10-cent debit on my trade. On a $22,000 stock position, that's not bad. I'm sorry, $26,000 stock position. And based on your original cost basis, it's really a $29,000 cost basis. So paying $10 for a repair trade, this is pretty much as good as it possibly gets. Now, like I said, this is because of the high market volatility environment. This is because equities are largely down, 5 to 7% from those all-time highs. So this happens to fit in this particular thesis. And what I'm going to do after that is I'm going to add my stock position to it. So what you see here is that what I have on the left-hand side is a stock position not accounting for the repair strategy, and on the right-hand side is a repair trade with the stock position. And as you can see, the P&L graphs are very different, right? The stock position, obviously very straightforward. The P&L graph of the repair trade, as you can see, what you get is an acceleration in terms of how much money you make, and then a drop off. So what you're effectively doing is you're trading off that unlimited upside in exchange for a little bit more of that kink, if you will, in that payoff graph. So I bought the stock at 290. It's now trading at 267. I've lost $23 a share multiplied by my 100 shares. I'm down $2,300. So what I'm trying to do is I'm trying to make back $2,300 on my repair trade. So what you start to see here is that if the stock gets back to about 278, so my original cost basis was 290. So if I didn't do anything and I just held on to the stock and the stock returned back to 278, I would make $1,100 back out of the $2,300 that I lost when I put on this repair trade. But as you can see with the repair trade, I've made $2,100 back. So what you can do is you can use this tool to see roughly at what point do you break even. Whoops, 287.5, and you'll 278.5, sorry. 278.5, that's roughly when I make my $2,300 back. So as you can see, what happens is I didn't get back to my break-even price, which is 290. I only got back to 278, and I'm able to make my $2,300 back. Now, if Facebook continues to rally back to the 290 range, here, if I had put on a stock, if I didn't put on a repair trade, I would make my money back and I would get myself back to break even. With my repair trade, I would make $4,500 back. So if it gets back up to my original break even, I actually make a profit on this trade. But that's the maximum profit that I can make, because if the stock keeps going higher and higher and higher, here I'm capped in the $4,500 that I can make, versus if I kept my original position, I can make more and more money. So that's just at the critical point of, that's just what a repair strategy looks like. But there's one big caveat. Let's say it gets back to 278, but let's say it gets back to 278 next week. Today is the 1st. Let's say by the 8th, it is back to 278. Guess what? If I had kept the stock position, I would make $1,100 back. But if I put on the repair strategy, I only make $967 back. So I'm actually worse off with my repair strategy than without my repair strategy. Because what you have to do is you have to wait to expiration. This is a slow game of time decay. You have to wait for that time decay to kick in. And as you can see, it really only kicks in the last couple of weeks. The rest of the time you're waiting. So this is what I mean about a repair strategy. Not only do you have to get the direction correct, you also have to get the rough timing correct. And you have to get the timing so that the stock gets back to your original break-even point or a little bit above it at close to expiration. If you think the stock's going to make a big move to the upside, you might be better off just not leaving it alone, not putting on a repair strategy. And that is probably the biggest challenge, in my opinion, of putting on a repair strategy, of doing something like this, getting the direction correct, and then finding yourself in a worse position than if you didn't put on that repair strategy to begin with. That's not a that's a difficult thing to sit through and then just have to wait, because as you wait, the stock could start declining again. And like I said, the repair strategy doesn't prevent you from losing any money. So if the stock starts to decline again, you're really at no additional benefit. So that's the biggest challenge when it comes to selling these types of these types of ratio spreads. So let's take a look at this. James said that he owns GE at $7. Is trading at $6.24. Now, that's not a very big loss here. You might be able to do one, but the challenge here is that you might not be able to find strike prices here. So let's take a look at whether or not we can do one on GE. So we buy a $6 call. A $6 call, it'll cost you 60 cents. Let's say we sell 2 of the $7 calls. As you can see, the 2 don't quite offset each other. It's not bad. You're paying $15 for it on a, what effectively is a $700 position. That's okay. So at this point, if you get back to, let's say probably 6, maybe 70 or so, you'll be able to make a slightly higher profit. But you see what I mean here? Once you factor into transaction costs, you're not much better off than just the stock position here. So on a low price stock like GE, you're less likely going to be able to put on a successful repair trade. Same thing for Rahim, which is WES. Same thing here. You own it at $8.50, $7.79. From my perspective, there's just not enough strike prices between the current price and your original cost basis to find an effective hedge, in my opinion, or effective repair strategy. Now, SLV, Michael's long SLV at 24.60, it's trading at 21.64. Let's take a look and see if we can find a repair strategy. So we buy 1 at 22, we sell 2 at 24 and a half. So this is one that does potentially work out here. So it's a $2,400 position. It only costs you $9 to put on this repair trade. So if your original cost basis is $24.60 and is currently trading at $22.09, that's $2.50. So you've lost $250. You're trying to get yourself back to $250 gain before your break-even price. So, oh, sorry, this does not include the stock leg, that's why. What you're trying to get yourself back to is $250 gain. So your break-even price is roughly 23.3. Your new break-even price, I should say, is 23.3 at expiration, which is November 13th. You can play around with the different expirations. You can play around with the slightly shorter dated expirations, see if you can find one. But, from my perspective, the fact that you're able to find one here for $9 tells me that you really have to go out to November 13th before you're able to find one. If you go to November 6th, you're starting to pay $16. If you go down to October 30th, you're starting to pay $35. At some point, it's no longer worth it to pay to get into that repair strategy. It only works if you don't really have to pay anything. So $9 is an example of where you're really not paying a whole lot to put on this repair strategy. Jake is long Exxon at 45. So this is an example where this is way too far out of the money. There's no chance in hell you're going to be able to find a repair strategy on ExxonMobil, because if you sold the 45 strike, which doesn't even exist, so if we go out to November, is there a 45 strike? There's a 45 strike. You're only collecting 12 cents. That's not enough at all to pay for a trade. This is an example of a trade where it's better off to cut your losses and get out rather than trying to put on a repair trade. Bank of America. Alex owns Bank of America at 27, currently trading at 24. This might be one that we could find. So let's go out to November. If we sell a 27 call option, that'll bring in 39 cents. That's not a whole lot to buy a, well, we're selling two, and to buy a November 24 and a half or 24s cost you $1.47. So here, this is an example of a stock that's down too much to find a repair strategy. You're down well over 10%. You're closer to 15% on this trade. So Bank of America at 27, not suitable in my opinion. Even if you go out all the way to November, still costing you $55 on a $2,400 position. In my opinion, I don't think this is one that you're gonna be able to find one on. Cisco at 40. Isn't Cisco trading above 40? Oh, it's trading at 38. Okay, so this is an example of one where I don't think you've had enough losses to warrant putting on a repair trade. So, you can have a trade that's gone too far where you can't put on a repair trade, but there's also a trade that just hasn't gone far enough to even warrant a repair trade. And I think Cisco, if you own it at $40, is an example of this. You're only down $1.50. Selling a $40 call option, selling two of these will collect $1.16 each, and then to buy 30, let's just call it a 38 and a half, will cost you $2.17. So here you're taking in a fairly large credit. So you don't want to trade these at a large credit or at a large debit. So here is an example where if you find yourself trading one of these at a large credit, that means that you are, in my opinion, not deep enough in losses to warrant a repair strategy. You could do one here for October, which is 30 days away, and it improves your break-even price by a little bit. So if it gets down to maybe 39 and a half, you'll be able to make your money back as opposed to if you just bought the stock. But this is an example of one where I just simply don't think that you've lost enough to warrant putting on a stock position. IDOS, I don't know what that is. And I don't think I'm able to find that stock ticker. So if you tell me what stock ticker that is, I'm happy to take a look, but I don't know IDOS, and I certainly can't do that. Co-Diagnostic, you're owning at 15. Here's my concern about Co-Diagnostic. I don't know what stock this is, but I'm pretty sure it's not a very liquid stock. Spreads are probably really wide, so I don't think you're gonna be able to find a particularly great one to do this on, but let's see. Sold the 15s for $1.85, or let's just say you get it closer to the midpoint at $2.55. You buy a $13 call option for $2.90. You're able to trade this at a trade cost of 20 cents. So yes, you can do it, but let's see. So the bid-ask price on this is pretty damn wide. So I'd be surprised as to whether or not you'd even be able to get filled on this. I'd be more concerned about whether or not you can get filled on this more than the repair strategy. The repair strategy looks okay, but I don't think you're going to get filled on this, to be perfectly honest. Intel at 55. Intel at 55. It's currently trading at 52. Okay, let's take a look. Let's sell one at 55, two at 55. We're going to buy a 52. Let's just call it 52 at $3. That trades it at a net credit of 57 cents or $57 here. So this is also an example of one where I just don't know that you've lost enough on this particular trade, but it can warrant, maybe you go a little, maybe like in October, 52 and a half, 52, 55, or maybe a 52 and a half might be more suitable. Going out to October, this could be a repair strategy that you could put on here for Intel. And then, so for example, it's trading at 52 and a half. Your original cost base is at 55. You probably only have to get to about 53, maybe 75 to break even. somewhere in that range. I'm just doing some math in my head, but roughly $300 that you've lost here, you'd be able to make back if it got back to 53.75, which is, you know, basically this resistance level right here. So if it got back to that resistance level, you can break even with this October 30th 52.5, 55 ratio spread or repair strategy. Pfizer at 36.5. So well, your cost base is below the current price. So Barry, I don't think this is a trade that you need to repair because you're actually profitable on this trade. Lisa is long Apple at $1.28. So 128 is perhaps a bit of a stretch, but let's take a look. So we sell two of the 128s. That'll collect $3.40, $3.60. And what we're going to try to do is we're going to buy let's call it a 117. Okay, so this actually works here. You're only paying $55 debit, which is a little bit on the expensive side, but we are talking about a $12,000 position. So paying $55 for a repair strategy may be something you're willing to do. So if you own the stock at 128, it's currently trading at 116. You're basically at 117. Let's just call it you're down $1,100. So you're trying to get back to about $1,100 in gains. So the stock only has to rally back up to 122.80. 122.80 is up here roughly. You would need Apple to get back to 122.80 by November 13th to break even instead of requiring to get all the way back to 128, which is obviously a taller order. So this is one that you could potentially find here on Apple. So I will say in normal circumstances, when volatility is not this high, I think this is a position that would be difficult to find that a repair strategy on. But because of the higher volatility, you're actually coming out okay. Jacob is long SSSS, which I've never heard of, Suro Capital. And I think this is going to have the same problem as the CODX, the co-diagnostic one, where perhaps the trade is, perhaps the options are not very liquid. So you own this stock at you own it at 14. So here's an example of a stock that I think has already gone too far to be able to do this. First of all, there isn't a 14 strike, so you can only sell a 15 strike. That only collects 25 cents, and that's definitely not going to be anywhere near enough to pay for the 95 cents that you all have to pay for that. So here, you know, you're paying $55 on one that only costs you $1,400. This is a stock, in my opinion, that has gone too far to find a repair strategy. Herb is long ATKR. I've also never heard of this stock. At 26.18. Let's see. I don't know if that there's a 26 strike. There's a 25 strike that'll collect 275. And sell two of them for 275. And then, wait, those are puts. Sorry. Selling call. And then I need to buy one of the 22.5s for $1.95. Okay, so here's one that you can actually find. Now, as you can see, the bid-ask prices are really wide here. So I'd be surprised that you're going to be able to get filled at this particular price that we have on the screen based on the midpoint, because the bid-ask price is showing that this will cost you $2.15. And I wouldn't trade this at $2.15. It really comes down to whether or not you can get filled. Cisco at 43.50. I think we already went through a Cisco one. Stan wrote work, but I need a cost basis. Raj bought Gilead at 68.75, 68.75. So this might be one that we could find. So let's take a look. Sell two of the 68.75. So let's just call it 68.5. Sell two call options. We buy one at the current price, which is 63. So this has a trade cost of $62. Now, this also has fairly wide bid-ask spread, so be careful. I don't know that you can get actually filled at this 62 cents or so, but let's see. The 62 cents is what you're trying to get filled at. You bought it at 68.75, so 68.75 minus the 63.23. You're down about $552, so you're trying to make back $552. And what that means is that the stock would have to get back to about 66.5 in order for you to break even by November 13th, a little better than the 68.75 that you own the stock at. Herb has GDDY. I think that's GoDaddy, but I think you're going to have the same problem as the other ones where it's just not very liquid. You might have the same problems. Jason is long IBM at 126. 126, that's a reasonable price. I think that you could potentially do a repair strategy here. We're selling 2 of the 126. And we're buying a 122 call. You can trade this at a credit for $1.07. So here's an example where I actually think that, let's do this. Let's maybe buy a 123 call. This is where, because you're getting such a large credit here at $1.52, what this tells me is that you just haven't lost quite enough money to make sense to put on a repair strategy. This is down less than 5%. So I don't think that this is particularly a suitable one for putting on a repair strategy. IWM at 162. So this is one that I do think is in the right realm here. What's currently trading at 152. So if I sold the 162 and I bought the 152.5, this trades, this is a fairly large debit. So this is one where, you know, you're gonna have to pay a little bit of money to put on a repair strategy. It's quite expensive here, $1.79 for a repair strategy. I think that this is an example of a trade that perhaps has gone a little too far to put on a repair strategy. Okay. I think that covers the examples that I have time to go over here. What I do have a few minutes for is to answer some questions. So there's a chat window and there's a Q&A window. I hope that at least through the examples that I was able to show you, that you can get a sense for how you would take a stock that you own, put in the original cost basis, sell 2 cover calls or sell 2 calls at your original cost basis, buy 1 call at the current price, and see what that comes out to be. If the net between the 2 come out to be close to a net 0 credit or debit, that means that you found a repair strategy that can potentially work for your trade. If you find that it's a large credit, that means that you didn't move far enough to warrant putting on a repair strategy. If it's a large debit, that means the stock has moved too far for you to even think about putting on a repair strategy. And the big thing to remember is that you're trading off 2 things. You're trading off upside return in exchange for a better break-even price, but it doesn't prevent you from having further losses if the stock continues to move lower. So with that, that covers what I wanted to share with you here today. Like I said, there is a chat window and there is a Q&A window. If you have a question, please type your question into the Q&A window, and I'll try to answer your questions out of that tool, out of the Q&A window, to hopefully help answer a few questions here. So Ron is asking, can repair work inside my IRA or Roth IRA? Don't think so. You can sell a cover call in your IRA. If you can trade debit spreads, then you should be able to put on this for your portfolio. It really just depends on whether or not you can trade spreads in your IRA. William is saying, does it ever make sense i.e. if the loss has just landed at a support level, to just buy a short-term call, sell the stock to reduce risk, and just play the call to get back to break even? So you're saying get rid of the stock position and just buy a call option. You can, but you are adding more risk to your position because the call option is not free. The whole point of the repair strategy is that you're not adding more risk to your position, because if you buy a call option and sell your stock and the stock keeps moving lower, you've now lost more money than if you just held on to it. So you can, but you're adding more risk. Can you please explain why it is not a good strategy to initiate a repair strategy if it's a large credit? A large credit just means that you have nothing to gain. You're now capping out upside for the stock position that you have. You don't want to cap the upside here too much, because the big risk that you take with a stock investment is that it can decline. You only want to take on that risk if you have upside. If you're taking on a large credit, then you're reducing your upside, and that's what you don't want to do here. Is buying a put diagonal is an option? Is buying a put diagonal an option? Not for a repair strategy. You know, a put diagonal makes you money if the stock slowly grinds lower. So you could potentially put on a put diagonal maybe to hedge your position if you think the stock's going to keep moving lower, but not as a repair strategy. Can the same strategy be used for options that have gone wrong? No, just because you can't sell a cover call against an option that has gone wrong. This is only for a stock position because that allows you to sell that cover call. Ronald says something that I think is interesting, and I largely agree with it. Ronald said, I followed it, but too much trouble. And you're absolutely right, Ronald. In many cases, this is a lot of trouble for a potential get yourself back to break even. But like I said, there are a lot of nuances with this strategy. And this is why this is not a strategy that I deploy very often in my portfolio. But for some people, you might want to explore. And I do think that learning how to put on a repair strategy is a good exercise in learning a little bit more about options and just understanding how creative you can be with options, because I think this speaks more to just the creativity that you can create using options by trading off some of that upside in exchange to getting a better break-even price without paying anything for it. This is the beauty of options, is that it gives you these options to be able to do them. It doesn't mean that you have to take them. It doesn't mean that you should take them. It just means that you should learn how to be creative with options and trade off different payoffs for the ones that you really want. Raj is saying, would selling a call credit spread be a good idea to repair? No, because selling a call credit spread adds more risk to your strategy. The whole point of repair strategies is to not add additional risk. Can I repair an ADP put spread? Again, you can't repair a spread because you can't sell that additional cover call against it. The only reason that you're able to repair a stock trade is because you can sell that cover call, and the premium on that cover call is what you're using to pay for that debit spread. So what you're effectively trying to do is get a free debit spread out of the cover call premium that you sell, and that's how you get yourself back to break even. Sorry, but please explain again why you have to hold it to expiration. Because if the stock makes a big move prior to expiration, what happens is you still have actually a loss. So actually, let me remove the stock leg. So let's say I put on this repair strategy for this particular stock, and let's say in a week, the stock rallies back up to your cost basis. What happens to the repair strategy? Does it make you money? No, it loses you money. You actually lose money because you're short 2 options and you're long only 1. So when the stock rallies, you lose money. The only time you make your money back is by holding on to this trade. You have to wait for that time decay to kick in, and that time decay takes time. That's why you have to hold it to expiration. If I have a call down 20%, can you use this strategy? In theory, if you're able to sell a call against that and fund the premium to pay for it, but I doubt you're going to be able to do that, Richard. So my guess is that you can't, but I've taught you the tools. You have access to the platform. You can try to see if you can make it work, right? That's the whole point of this this tool. That's the point of this webinar, and that's the point of this tool. At the end of the day, there are lots of things that you can modify with what we're teaching you. But if you really learn what we're doing, or if you really understand what we're doing, you can then use the tool, model out a repair strategy on the call option you own, and see if you can put on a repair strategy. I'll be honest, I haven't tried, but maybe you can try and see if you can put one together. Kamal is asking, what do you do for repair when you do not have any stock? So this is only for stock positions. Again, if I own the stock, why wouldn't I do this on all my stocks instead of just one cover call? So Herb, like I said, there are many challenges to doing this. If you put on a repair strategy and the stock rallies quickly, you're actually going to lose money. You have to hold on to it. So it only provides a little bit of juice. And the other reason that you generally may not want to do it is because it limits your upside returns. So you might very well do it for all your stocks, Herb. That's completely up to you. If you find that this is a better strategy than just selling a cover call, by all means. But again, this only works on stocks that you're down 5 to 7% on, and not all your stocks you're down 5 to 7% on. Trade to buy Tesla at 300. I'm not sure what that means. Is that a question or a statement? Waleed, hi Tony, why don't you use the money you collected from the cover call and use this money to buy puts? In this way, if the stock goes down, you will still be covered on the downside. Well, here's the thing, the premium that you receive on the cover call is not going to be enough money to buy a put option, first of all. Second of all, that's a different, if you're trying to buy protection, sure, that works. If you're trying to prevent further downside losses. But from my perspective, if you're trying to prevent further downside losses, sell the stock. Why are you holding on to a stock that you think is going to continue declining in value? Don't do that. Sell the stock. Don't create all these crazy strategies just to prevent yourself from losing money, when the easiest way to prevent yourself from losing any more money is just to sell the stock. There's much easier ways to do that. Sell 2 cover calls at cost price. Again, Stephen, I don't know if that's a question or a statement. Can we combine with cover call? This is effectively a cover call and a debit spread. So yes. Boris, thank you, Tony. Interesting strategy that I was unaware of. Do you have a quick comparison of statistical results of this strategy versus simply selling cover calls to lower basis? I don't, Boris, to be perfectly honest, but I will say you are short 2 calls, which generally speaking is always, how should I, that's a good question. I would say that if you're able to put on one of these trades for a net credit of 0 or a net debit of 0, you will likely in the long run come out ahead with this strategy than if you just sold a cover call. Because you don't have any additional downside, you're limiting your upside the same way you limit the cover call, and you have the potential of making more money in the short run. So if you're able to trade this for a net debit, a net credit of 0 or a net debit of 0, I do believe in the long run you will come out better in this particular strategy than if you just sold a cover call. But there's not all the time are you able to trade one of these for a net credit of 0. You're going to find that it's not very often that you're going to be able to trade these for a net credit of 0. Will this work with the synthetic stock versus owning the stock? Yes, it will work for a synthetic stock. Because you're long the call, you can always sell the call against a long call. So yes, however, you wouldn't be able to do it if you could only do it if the call that you're selling expires before the long call on the synthetic stock position. How are you selling 2 cover calls while owning 100 shares? You're not selling 2 cover calls. You're only selling 1 cover call, and then you're trading a debit spread on top of that. So you're not selling 2 cover calls. You're only selling 1 cover call, but then you're selling a second call against the other long call that you're purchasing. That's why you're short 2 calls, but you're only short 1 covered call. Herb, how about just using a cover call out of the money strategy where the strike price selected is near resistance and do it over and over again, assuming the stock price doesn't get called away? Harley, yeah, so that would be the, if you're not down 5 to 7%, that is the better strategy to do, is just selling cover calls. Stephen is saying, buy 1 call at price. What strike price do you buy? You buy the strike price at the current stock price. So with any of these repair strategies, the long call is always the current stock price. What about selling a bear call spread to recover your losses? Selling a bear call spread adds more risk to your portfolio. So selling a bear call spread to recover your losses. That's another way of doing it. Selling a bear call spread. You could do that. I'm trying to think. Selling a bear call spread. That also works. So again, this is by no means the only way to do it. And when you really start to think about it, there are so many different other variations of this that you can do. You don't have to do a 1/2. You could do a 2/3 ratio. You can sell a bear call spread. I'm just trying to think, a bear call spread. Again, a bear call spread adds more risk to your portfolio but it is hedged by the underlying stock price. So that works as well. Would it be prudent to add a put option to a repair? Would it be prudent to add a put strategy to a repair strategy in the case the stock moves lower? Barry, you can, but that adds risk. So you're going to have to pay for that put option. But you can, absolutely. What strike price do you buy? I think I answered that question. Ralph is saying at 5 to 6% drop does not seem a worthwhile to put on a repair strategy in a volatile market. Your thoughts? That is what I was trying to say in the beginning by saying that I don't do this very often, because generally speaking, it's a strategy that adds a lot of complexity with not necessarily a whole lot to add to your portfolio. But I actually think that this is a better exercise in just thinking about how you can utilize options, because for those of you that never thought that you can put on repair strategy, this might be illuminating and just helping you understand how you can shift around, you know, where you can potentially gain and shift that around to somewhere where you want to be gaining somewhere else, giving away some upside in exchange for some short-term upside. That's really the power of options, is really allowing you to shift around your risk profile to what you want, to fit what you want. And options, you can, as long as you understand the fundamental building blocks. So last month we talked about buying versus selling options. We talked about those fundamental building blocks. Today we're really putting those fundamental building blocks to work to show you how you can use those fundamental building blocks, shift them around, and give you the payoff graphs that you're really looking for. What is the usual percentage of stock that has a good bid-ask spread can go down before it does not work? I'm not sure what do you mean by the usual percentage of a stock that has a good bid-ask spread. Oh, like I said, Eileen, it's about 5 to 7%. That's the range of which these types of repair strategies work. What's the ideal expiration we should consider for this? Usually 30 to 45 days is the typical, I would say, days to expiration for a repair strategy. What happens to dividend payouts when you have an option? Does this have assignment risk before close? It does, but you're covered. So you were covered on the call, on the cover call, and you're covered on the debit spread. So your assignment risk is zero from the perspective of you're always covered. Sorry, I meant an out of the money calendar or diagonal. Victor, I'm not sure what you're referencing, if you don't mind clarifying. Ron is saying JD trade was canceled, not filled. Ron, I was able to get filled on that JD trade. So I still think actually JD is still a valid trade, to be perfectly honest. How do you repair a credit spread? Diane, you know, from my perspective, credit spreads are limited risk strategies. They're really not meant to be repaired from my perspective. Different people will have different philosophies on this. From my perspective, if a credit spread didn't work out, that means your directional thesis was wrong. And at some point, you should just accept that and move on to the next trade. And if that next trade happens to be the same stock, because now you think that stock is going to turn around, that's okay for you to put on a new credit spread. But what you should first do is get out of the losing credit spread, remove the emotional attachment to that loss before you decide whether or not you want to put on another credit spread on that exact same symbol. You know, sometimes once you remove yourself from the loss, you realize that you don't want to put on a new trade in that specific symbol. You always want to remove your emotions from, a lot of times people, quote unquote, want to repair just because it's a loss and they don't want to take on a loss. And that's the hardest lesson to learn. And I highly recommend you to take a look at the video that we did last month on trading psychology. It's usually in the attempt to prevent losses that we end up taking some of our biggest losses in our portfolio when we try to repair a losing trade. Dollar cost averaging on a trade that hasn't gone well, and end up losing more and more money. So there's no repair strategy that doesn't take on any more risk. The only reason I'm bringing this trade up is because this is the only repair trade that doesn't risk more money. You're not putting any more money at risk when you put on this type of repair trade. When you say you want to repair a credit spread, you're just going to have to put more money at risk to repair it. And I never recommend doing that. You can do that. I'm not saying you can't, but take the loss first, then decide whether or not you want to place a new trade on the same symbol that you just lost money on. 9 out of 10 times, once you take that loss, you realize that I don't want to trade that trade again. You simply want to deploy your capital somewhere else, but sometimes you do. And if that's the case, you do put on that second trade, put more money at risk, but only do so once you've removed yourself from that initial loss. John is saying, I like to roll my put trades for credit if bullish, so when stock comes back, I make more money. I like to roll my put trades for a credit if bullish, so when the stock comes back, I make more money. John, if you're referring to a short put, certainly, but that's a different strategy than what we're talking about here. The cover call limits my upside returns too. That is absolutely true. Glenn, how long do you hold long positions? Then there are core longs and shorter long holds. When do you personally do them? So I would say most of my stock positions are long-term investments. I generally am not an active stock trader, to be perfectly honest. So my stock trades usually will either be long-term capital gains because I've held on to them for a long amount of time. Rarely do I hold on to stocks for a short amount of time, to be perfectly honest. Will this work for dividend paying stocks? So dividend or non-dividend paying stocks, doesn't matter. This will work for all of them. Question, do you know what happens to option contracts, both a call or a put sold against shared own when the company is purchased by another public company? So John, it depends on each individual acquisition. So the OCC will publish what the option contracts will be adjusted. Usually you will simply get contracts of the new entity. So but it depends on each acquisition, so it's hard to make a general statement. Can you please show bear call spread in the tool for us to understand the strategy? So Andrew, that's what I'm doing next week. So please join us next Thursday, where I'm going to be talking about credit spreads. So I would love to show you, Andrew, but that is what we're covering next week. If we're really convinced on the stock, what about selling a cash secured put? If you're really convinced on the stock, what about selling a cash secured put? You can, Cliff, but then you're taking on the same risk as dollar cost averaging. So the point of this repair trade is so that you're doing it with no additional risk. All of these other suggestions that people have raised, these are all valid suggestions, but they all add more risk. And the whole point here is to try to get yourself back to break even without adding risk. So you can sell a put option. That's virtually the same as dollar cost averaging onto a losing stock position, which as long as you understand the risks of doing that and you're comfortable with it, that is a perfectly valid strategy. Generally, you recommend to do options for 45 days. What is this reason? That's just the optimal days to expiration for whenever you're selling premium, because in the 45 to 21 days, that's when you have a fair amount of theta decay in terms of per day, but relatively low gamma risk. So that's why we go 45 days out. Fernando saying, hi, Tony, I have a question for options in general. If you open a position having a theoretical 70% probability of profit, why would you close a position with a stop loss before expiration? Wouldn't that be going against your probabilities in the long run where you have a 70-30% win ratio? So Fernando, the pop is always holding to expiration. I don't know, most traders generally don't hold them to expiration. So your pop doesn't actually mean a whole lot, in my opinion, if you're not holding it to expiration. So I wouldn't go off of the pop as your specific win rate. The pop is only if you hold it to expiration, but we rarely hold positions to expiration. Instead of ratio, can you do a call diagonal repair with the cover call option? Victor, I haven't done that myself, but I'm sure that you can. You just have to model it out, and if you want to be a little bit more creative, generate a little bit more premium for your repair strategy, you certainly can, but you're adding a little bit more complexity to what is already a fairly complex trade. Hi, Tony, I really love your videos. I am new to options and I am actually interested in learning from foundation. Where can I access beginner courses? Thank you so much. So great question. So you can find us on YouTube. I think the best place to find us is here on YouTube. I'll post a link into the chat window. We have a playlist just for beginners. So we have a beginners options master course. You can use that as a starting point for your strategies. So actually, let me just show you on the US site. It's called the beginners options trading playlist, which I will also send you a list for. And all of our beginners topics are here in this particular playlist. Especially for those of you that are new to options trading, it's a great resource to help you learn how to get started. Okay, I think that covers what I'm able to cover here today. We've gone over an hour and 15 minutes. Thank you so much for taking your time out here this afternoon. I hope that you guys learned something about how to put on a repair strategy on a stock position that you own. I hope that you also learned that it's a challenging trade. It doesn't work for all positions. So hopefully this gives you some insights as to when you might want to deploy it, when you might not want to deploy it. And even if you don't deploy it, I hope that you learned something in terms of just how creative you can get with options and how you can use the OptionsPlay tool to tinker around and play around with it and see what you can create from a payoff graph perspective. Thank you so much. Have a great evening. I look forward to seeing you guys here tomorrow morning during our Friday morning market outlook session. Like I said, I have a special announcement for next Friday, which we're going to do an election special. A lot of you have been asking me for that, so we'll be putting that together here next Friday. Have a great evening, and I'll see you guys in the morning.